Thank you very much, Luke Frieden, for your very forthright speech, clear to the point with clear views. We always, this is what I take, think about 3 dimensions when we talk about European regulation. We know the 3 pillars of Basel. Now we have Basel 1, 2, and 3. And you added now the 3 dimensions which are currently discussed and worked on the European level with respect to regulation, the single supervisory mechanism, the recovery and resolution system, and also something which is far behind but which has to follow up at a certain point, deposit insurance. And this is only the name of the game in Europe, let alone the global coordination of all of this. But what I also take positively from this as a banker, and banks take the most criticism right now in today's society, is that we should not forget we're talking about a very important issue, finance, and you said something which I will keep in mind, finance channels ideas into action. And before we brag and boast too much about it, you said it's only a means to an end. And I think this is what we have to understand at the same time. We are helping to channel ideas into action, and we are only a means to an end. And you also mentioned something which Wolfgang Hartmann asked me to perhaps sneak it into the discussion later. Now you did it. Besides regulation, there's always the dimension of individual responsibility. Thank you also for giving a reminder to this, which has nothing to do with regulation, but everything to do with ethics and education here. Dr. Elke König, the floor is yours now. Thank you.
Well, thank you. When I accepted to give a keynote speech here, I understood it's a challenge to be on the last panel. But now it's an added challenge to be speaking after you. I'll try to cope with it somehow. I think the financial crisis of 2007 and 2008 brought out into the open weaknesses in the whole regulatory structure. That, I think, is a fact. The thousands of, at that time, existing international regulatory standards, which many countries had transposed into their own national law and had thus made binding on regulators and the institutions they regulate, were deficient in many areas. In addition, there were a number of blind spots. Therefore, a comprehensive regulatory framework had to be created which would enable supervisors to keep risks on the financial markets under control. That is the theory, or that's what we are trying to aim for. And just as everyone has done, I would like to remind us of the 2008 request of the Group of 20 when they said we pledge to strengthen our regulatory regimes, prudential oversight and risk management, and ensure that all financial markets, all products, and all participants are regulated or subject to oversight as appropriate to their circumstances. And the as appropriate is perhaps a little answer to what was discussed on the previous panel. In so doing, the G20, as stated quite rightly, attached great importance to appropriateness. Regulation was to be efficient, but should not stifle innovation. Appropriate, by the way, means more for the larger institutions, less for the smaller ones. It's not just less for the smaller ones. That sounded at that time promising, and I think there was a lot of energy put into that. Some regulatory gaps have been closed in the meantime, but a number of difficult questions still remains unanswered, and I'll try to address a few of them. I'll start with a topic which is probably not the highest on the overall agenda, but as Stephen is on the panel afterwards, I'll start with it. Rating agencies were among the prime candidates when it came to identify the main culprits for the subprime crisis. But that doesn't mean to say that they should be condemned wholesale, to be fair. For me, one thing is clear, was also said already. It is first and foremost management's responsibility or everyone's responsibility to measure risk. Relying blindly on rating agencies is not acceptable, neither for companies nor for consumers. But we need ratings that are independent and methodologically impeccable, and for what we must subject rating agencies is And for that reason, we must subject rating agencies to comprehensive regulation, and that, to be clear, at a global level, not just regional. A lot has already happened on this front in the European Union, but we need a regime that is consistent worldwide and not a piecemeal approach. And I hope that we do not lose sight of this issue on a global basis. Another great regulatory vacuum could be found in the credit derivatives market, or I would say in the derivatives market as in whole. Regulation of the two main markets for OTC derivatives, Europe and the US, has by now been significantly advanced. In Europe, the European Market Infrastructure Regulation, EMIR, a word that led to something totally different when my daughter listened to one of my speeches. I don't know why she did, but she thought of something else in EMIR, had been brought in, and in the US, Dodd-Frank. At the heart of the new legislation lies an obligation to clear certain OTC derivatives through central counterparties, combined with tighter requirements for the latter's authorization and operation for both centrally cleared contracts and contracts that are not subject to central clearing. Adequate and high-grade collateral must be provided. All in all, EMIR and Dodd-Frank will therefore bring greater stability to the market. However, high-grade collateral is in short supply. We must also keep a close eye on if and how market participants convert lower quality collateral into higher quality collateral. The buzzword is collateral transformation, and it's a buzzword that makes me a bit nervous, or more than just a bit. No new systemic risks must be created by this. Also, to add to this list, asset encumbrance is the flip side of the trend towards greater collateralization. If the proportion of a bank's collateralized funding increases, for whatever reason, in the event of an insolvency, creditors of unsecured loans and depositors are left out. Another challenge that must be overcome is that EMIR and Dodd-Frank must not lead to the OTC derivatives market being split in two. That could happen if the equivalence of EMIR and Dodd-Frank were to be questioned or even denied. If market participants operating in the other legal system had to re-register, that would be a deterrent to cost and competition, and therefore I think this is a key topic for the Commission to tackle. In short, we have solved a lot of problems, but there's still a lot to be concerned about or to watch. Let me now turn to the markets that were already regulated before the crisis, thus to banking regulation. I'll spare you insurance today. As it turned out, a number of the crucial rules of international banking regulation were inadequate or flawed. Basel I, for the first international solvency standard for banks, was just not up to speed with the risks evolving. It allowed certain risks not to be backed with capital, and it was a bit a one-size-fits-all, so it was not risk sensitive. The subject of risk management wasn't covered at all in Basel I. There was no significant improvement on this front until Basel II. And a number of you have heard me saying we can talk a lot about capital and additional capital for banks. Capital will always be falling short in times of a crisis. So for me, risk management, business strategy, and all these discussions are by far more important to be forward-looking in our approach. But I'm shooting a bit ahead. The crisis proved that what we had recognized as capital in the past was frequently not sufficient to absorb losses. Either the capital cushion prescribed for banks was too thin, or it was capital that could not be used to avert insolvency because it could not be drawn on until the insolvency had already occurred, and that's a bit late. But there were also legitimate doubts concerning risk-weighted assets. They still are, and I think we need to address them. Basel III imposes, therefore, much higher requirements for the quantity and quality of regulatory capital, and also addresses the calculation of risk-weighted assets. That will be an ongoing exercise, I can assure you. As it introduces globally consistent globally consistent quantitative liquidity standards. That was a blind spot of Basel II, definitely. You can argue over detailed questions regarding Basel III, but there's no doubt that it will help us to make not only individual banks, but also the whole financial market more stable. So hopefully it will be globally introduced rather sooner than later. I'm sure for Europe, and I think we'll have to take the word of the US for granted that they are also implementing it rather sooner than later. Since Basel II, risk management has become the second key regulatory oversight tool, alongside capital. I think it's fair to say that during the crisis, we found out that risk management systems of many banks were unable to identify risks in good time or assess them properly and take appropriate control measures. In many cases, the system's braking function was just not adequate. It took too long, and the view the banks had implemented in their models were too optimistic. By now, new provisions have been added to risk management requirements internationally, and further changes are imminent. We take this subject, as I said, very seriously, especially when it involves systemically important banks, which we also supervise particularly closely in this respect. Or, as I said, proportionality works in two ways. It is added supervision for the systemically important banks, and it is adequate, perhaps less supervision for the smaller banks. The collapse of such bigger institutions, so be it domestic or global SIBs, can trigger shock waves that also have considerable knock-on effects on the real economy. I think no doubt about that. 6 years after the financial crisis erupted, banking giants can therefore still count on the state supporting them in an emergency. Or, to be fair, 6 years after the crisis, you still see that banks cannot just collapse, but are rather nationalized. I don't think that that's something we need to be proud of. This de facto insolvency protection results in lower cost of capital for these banks, plus important functions of the market system, accountability and liability for business dealings are abrogated. For a long time, our regulatory options in this area were limited to non-existing. By now, some important regulatory steps have been taken, or at least are introduced. Firstly, it is essential to strengthen individual institutions by means of a capital surcharge. That's one thing that's addressed. Frameworks to that effect have been adopted for global and for national systemically important banks. Secondly, we must restore the market system for all institutions. To that end, we must credibly threaten even large banks with letting them fail if they become not viable. I wanted to avoid the word insolvent. That is possible only if we are able to effect an orderly resolution of any distressed banks. BaFin is able to do that based on our national legislation. But to be fair, it's national legislation, so I would rather not like to work out how that works for a bank that is working cross-border. But to be fair, for international banks, we need an effective cross-border resolution regime. We need it for Europe, and it would be better if it were a global system. The Financial Stability Board has laid the foundation for this. The European Union wants to follow suit with a directive intended, among other things, to implement the FSB guidelines. And the European Union directive will go further than just the FSB with its key principles. It will include preventive measures such as recovery resolution plans and it will also have some early intervention powers. Supervisors will be able to intervene in the structure, the business model, and management of large banks, in particular, and will be able to make sure that resolution can be effected more easily, if it's ever easy. The draft directive also provides for new resolution instruments, such as bail-in debt. And keep in mind, bail-in debt is only available if you're not overly encumbered in your assets. Otherwise, there's nothing left. The letter is intended to make creditors bear an appropriate share of the cost of a bailout or a partial resolution. I think I would full-heartedly agree with Minister Frieden to say what we also need is a resolution regime, but I'll come to the banking union at the end of my little speech. In addition, a group chaired by the governor of the Bank of Finland, Elke, proposed last autumn that the banks should be obliged to separate their proprietary trading business, to use that phrase, from their lending and deposit-taking business. That's the idea behind it, would prevent banks from funding risky proprietary trading, that's a dangerous word, activities with quasi-state guaranteed deposits. At the same time, a possible resolution would be made easier because it makes it a less complex, less interconnected institution. I think one thing that Elke's report is fairly outspoken on is he is not questioning the advantages of the universal banking system. He is just trying to address some topics to call it safeguard that system. Germany is a trailblazer in this area too, like we were on resolution plans. This time together with France, according to the German cabinet's plan, within a law that was presented, or a plan that was presented roughly a month ago, financial groups in which deposit-taking business is conducted, so most of our universal banks, will, under certain conditions, be obliged to ensure that high risk-bearing business is carried out solely by a separate financial trading institution. In addition to general supervisory requirements, the letter would also be subject to special requirements. I think it's a good approach, but one which also has its limitations. Structural separation is not sufficient on its own to get rid of systemic risks altogether. We would gain little if we encourage business to shift into weaker or unregulated markets, and that's at least a risk we have to face. Well, with this, I've arrived at a further, particularly great regulatory challenge, be it Basel III, capital surcharges for systemically important banks, Liikanen, Vickers, or whatever. When we tighten regulation, we must not forget that we may be maneuvering some market participants into moving business into areas in which life, from a regulatory perspective, is a little easier. By this, I mean, above all, the shadow banking sector or system, where regulation is weak or even non-existing. Quite a lot has already been achieved on the shadow banking regulation front, both at the European level and globally, but we haven't reached the finishing line yet. We need comprehensive regulation of the whole system, shadow banking system, and of all the links to the regulated sector. Well, last but not least, I think you would be surprised if I wouldn't touch on the on the single supervisory mechanism for the Eurozone banks. The European Central Bank will play a leading role in this. Even though I'm an advocate of strong European banking supervision, the Brussels decisions still leave me with a number of questions, just for the records. Will it prove possible to keep banking supervision and monetary policy sufficiently separate? I do think so, but we need to work on it. Are the respective responsibilities clearly delineated? I think so, but again, we always need to keep it in mind. If we succeed in building European banking supervision on a solid legal and organizational foundation, I have no doubt that that's our intention, then I'm firmly convinced that it can actually bring significantly greater stability because of its, call it, wide coverage or range. We talked about supervisors being a bit behind companies going forward. I think supervisors, to be fair, are not smarter than the banks they supervise. They are rather trying to cope with all these ideas. But supervisors have one key advantage. They can compare between institutions and thus business models. So the broader the coverage, I think the more we can probably build on this. Although I still wonder, to be fair, how effective European banking supervision can be if it, unfortunately, excludes the major financial center that is London. So for me, the challenge is we need to build a single supervisory mechanism that is that competitive and compelling that even the UK considers to opt in. I think that's at least a target for this group. Ladies and gentlemen, the crisis revealed regulatory weaknesses across the board. The repair work has been correspondingly extensive. I don't want to count all the legal acts that are implemented. The FSB is working with the global standard setters on many new rules and regulation. And I think we must continually ask ourselves whether those regulations are actually having the desired effect. Are they providing the right incentives, or might they be having unintended consequences or even conflict with with each other? The big challenge is for the next years to come to bring everything together in the comprehensive, stable, and coherent framework that we all are looking for. Thank you for your attention.